Good morning and a very warm welcome to today's webinar. It's about finding the investment path that suits you. Is the return really worth the risk? My name is Beatrice Chege. I'm a Business Development Officer at Absa Asset Management Limited, and I'll be your moderator for today. With so many options out there, from low-risk bonds to high-risk investments, it's important now more than ever to find an investment strategy that aligns with your goals and your risk tolerance. Making the right choice can be overwhelming, whether you are a cautious saver or an ambitious risk taker. So today's conversation is all about helping you to find, to understand your investment personality and to find ways of investing as you safeguard your investments and get the returns that you desire. So we will have a very interactive session today morning. We will have question and answers between every session. And we will also provide a platform, that is the chat room, for you to post your questions. At the end of the webinar, we will also have an opportunity for you to share your feedback through a QR code. The feedback will be about this webinar and any other improvements you would want or recommendations for topics that you'd want for future webinars. So today, we are privileged to have 3 experienced professionals to take us through the different topics that we have for discussion today. I'll introduce the first person on my immediate right, who is Mercy Gatukui, and I'll give up an opportunity to say something. Mercy, welcome.
Thank you very much, Beatrice. Good morning and welcome to today's webinar. I'll be taking you through our first presentation, which is on the macroeconomic environment. Just giving a bit of highlights on both the global and local economy, just to try and understand what has been happening in markets and how this affects our investments and the kind of returns that we're seeing. So looking at the global economy, we do note that performance has been stronger than initially expected. So we did see some shocks coming through from the market. Earlier in the year, we did see the US announcing broad tariffs across the board affecting all countries globally. Some countries were more significantly affected than others. And so in the initial aftermath of that, there was expectation that we would see a significant slowdown in global economic growth. However, subsequently to that, several discussions across the board, we did see expectations of growth improving. So the global economy is expected to grow by about 3% this year and 3.1% going into next year. Looking at inflation, we have seen a bit of mixed signals coming through, noting that we have seen inflation slowing down from the peaks in 2022. After the aftermath of COVID disruptions to supply chains, we did see inflation trending significantly higher. However, in the last 2 years, we have started to see global inflation trending lower. However, over the last few months, we have seen a bit of a divergence in major developed economies as US inflation has remained quite stubborn as a result of the pass-through effects of tariffs. However, going forward, we would expect to see a continued sustained slowdown in inflation, although we do maintain that some risks still persist from oil prices as well as geopolitical conflicts. We've also seen central banks pivoting in their monetary policy just to try and stimulate some economic growth, given, as I mentioned, the shocks that we saw earlier in the year. We have seen in the US, the Fed has started to ease its monetary policy. We have seen cuts this year of about 0.25%. In Europe, the European Central Bank has cut interest rates by 1%. And in England, the Bank of England has cut interest rates by 0.75%. So these lower interest rates are expected to improve credit conditions and to support improved performance of markets, although we do note that inflation does still remain the key risk here. As mentioned, the lower interest rates have gone a long way in powering the momentum that we've seen in equity markets. So we have already seen quite a good performance coming through from developed equities markets in 2025. This has largely been supported by strong corporate earnings as well as expectations of lower interest rates. We do, however, also expect that going forward, we could see limited upside given the current high valuations, as well as potential for volatility coming through from, as we mentioned earlier, geopolitical tensions as well as trade tariffs. We do, however, note that for investors who have a long-term view, we could still see pockets of opportunity to enter into the market. Any dips do still represent quite a good entry point to take advantage of any lower prices to position portfolios for long-term growth. Coming closer to home, we do expect that Kenya's economic growth will remain quite resilient. We have seen growth coming in at about 5% in the first half of 2025. This has largely been supported by positive performance of the agricultural sector, which is one of the largest contributor to economic growth. Kenya. We've had adequate rainfall this year, which has led to good productivity in the agricultural space and has continued to support growth. The fact that interest rates have also been lower in the period has also been a good booster for economic activity. We do realize last year we had quite high interest rates, which had somewhat stifled economic growth. So as the central bank has taken steps to cut interest rates, that has gone a long way in stimulating private sector credit growth and the economy as a whole. Looking at the Kenya shilling, we note that it has largely remained stable in 2025 after 2 years of quite significant volatility in this space. So we did see the shilling depreciating quite sharply in 2022 and subsequently appreciating quite strongly after that. This had largely been driven by a lot of the kind of geopolitical risks that we had been seeing. There were concerns around sustainability of Kenya's debt. However, the government has gone quite a long way in reassuring investors as well as restructuring the maturity of its foreign debt to ensure that it's more sustainable for the long term. And this has gone a long way in helping to stabilize the Kenya shilling. We've also seen diaspora remittances remaining quite strong, and that has gone a long way in boosting the shilling. Forex reserves have also remained adequate, and so the central bank has been able to support the currency. Inflation in Kenya has also followed global trends. So we did see inflation spiking in 2022. However, subsequent to that, we have seen a moderation in the same. Key inflation drivers in Kenya remain food prices and fuel prices. So as both have eased, we have seen overall inflation in Kenya easing as well. Going forward, we would largely expect that inflation will remain well within the central bank's target range of 2.5% to 7.5% for the remainder of the year. Of course, fuel prices do remain the key risk factor here, which could potentially lead to higher inflation. Interest rates as well have followed the same trend. We have seen after a peak of interest rates in 2024, we have seen a gradual easing of interest rates from high double digits to the current levels that we're seeing, trending towards between 7 to 9% on the T-bill front. This has largely been as a result of easing inflation as well as lower interest rates. So as the central bank has lowered the key base rate, we have seen market rates adjusting in line with this. And this is expected to continue at least for the remainder of the year and going into 2026. This will likely also go a long way in supporting banks in easing the cost of credit. And of course, cheaper borrowing does go a long way in stimulating economic growth. Looking at our local equities market, we do note that we've seen quite a strong rally in the NSE All Share Index over the last 2 years. And this is following a period of quite muted returns starting in 2020. We do understand that, again, we saw several global shocks. which also affected performance here locally. We did see the market contracting quite sharply in 2022 and 2023. However, as the macroeconomic environment started to improve in 2024, we did see significant improvements in performance of markets as corporate earnings grew positively, and investor sentiment improved around the Kenyan macroeconomic picture. So this year we've seen the market rallying by over 40%. This has been driven by participation of both local retail and institutional investors. We have seen a lot of interest coming through from market participants who want to take part in the profits that are being generated by listed corporates, even as dividend returns have been quite attractive. So in conclusion, what are we saying? We are of the opinion that the global and domestic macroeconomic environment has improved significantly, and this presents a good opportunity for investors who are looking to position themselves both for the short term and the long term. We still see attractive points of entry into whichever section of the market an investor may be interested in. We expect that the environment will be relatively positive in the next 12 to 16 months. So this would be a good time to enter into various asset classes which would be attractive for any investor. So on the global side, we believe this would be a good time to invest in diversified structured notes which have underlying assets of either bonds or equities, as the expectation is that as interest rates come down, we'll see positive performance coming through in both of these asset classes. This would also be a good time to go into index funds for diversified exposure into equities, which will benefit from positive market momentum. We also expect that short-term bonds are likely to do well and give steady income, as well as providing an element of safety. And finally, we would also consider investing in gold as a safe haven asset and for diversification purposes. Coming closer to home in Kenya, we do still feel that this would be a good time to increase exposure to risk assets. As inflation and interest rates have come down, we do expect that risk assets will perform better going forward. So this would be a good time to buy longer-term government bonds to lock in higher returns, even as we expect that rates will decline in the near future. Kenyan Eurobonds are also poised to earn enhanced US dollar returns. We did just see the government issuing a new papers over the last few weeks, a new 7-year and a new 12-year paper, both giving quite attractive returns, which investors could buy into. We also do recommend investing in some of the undervalued stocks which are trading on the local stock exchange, which are giving attractive dividend returns, and investors are likely to benefit from both a capital gains and a dividend perspective. And finally, even for our cash and near cash investments, it's looking like a good time to lengthen the maturity of those investments by cycling into more medium to longer term funds, such as fixed income funds. And finally, what are the key risks to this outlook? So as I mentioned earlier, geopolitics and trade tensions do remain the key risks to this outlook. We do still see continuance of conflicts in the Middle East and in Europe, as well as continued trade tensions. We do see news items coming through on trade tariffs every so often, which does introduce volatility in markets. But as I mentioned, this volatility does present good entry points for investors who are looking to position their portfolios for the long term. Thank you very much. And at this point, I will hand over back to our moderator, Beatrice.
Wow, thank you so much for that insightful presentation, Mercy. Mercy has basically taken us from the global stage to the local stage, that is the economies, and how they influence the investment decisions that we make. Basically, what she's telling us is think globally, but act locally. So thank you so much, Mercy. I can see there are questions coming in on chat. And the first question someone is asking, how do I protect and grow my investment in these changing times?
Thank you for that question, Beatrice. So the simple answer to that is diversification. So diversification helps you to protect the downside while also factoring in any gains or upside that you're looking for. So when you're looking to diversify your portfolio, what that means is to just have your investments not in one basket, but have it spread across different asset classes. So you would have some that are more short-term in nature, some that are more long-term in nature, some that have more defined income, and some that have potential for growth. So practically, looking at it, how you would structure your portfolio is you would have a portion that is invested in near cash or short-term fixed income securities. That could include fixed deposits or treasury bonds or money market funds. You could also have a portion that's invested in more medium-term investments with more stable risks, but with more stable income, but with potential for upside, such as treasury bonds. And finally, you could also have a portion that has higher risk assets, such as equities or offshore investments, and those would be the key drivers of growth in your portfolio. So that would take a balanced approach, which would moderate some of the risks that you would be taking in your investments, but still leave you with room for significant potential upside. Thank you.
Thank you for that answer. Well said. Keep the questions coming on chat. We'll keep asking our presenters to support us in answering the same. So, Mercy, there's someone who's asking about inflation. How does inflation affect me as a person? What should I look out for before I decide if it's a good time to invest or not?
So when we speak about inflation, inflation largely refers to the increase of goods and services year over year. So as we do note that there does tend to be a general increase in the cost of things, and a little bit of inflation is a good thing because it does encourage consumers to spend or investors to invest. If there was no inflation at all, there would be no incentive to spend money today because things would cost the same next year as they cost today. However, you also don't want a situation where inflation is too high because the value of money is being eroded too fast. For at what 1,000 shillings would buy you today, it could not afford even a few months down the road. So it's important for investors to invest in securities or asset classes which are giving them an element of protection against inflation. You want to have your money somewhere where it's earning something, and ideally the rate of return should be higher than inflation just to protect the value of money. So it's important to consider what the inflation rate is even as you're investing your money and ensure that the rate of return that you're getting is above inflation to ensure that you're maintaining the value of your money. Thank you.
Well said, well said. Again, I repeat our punchline. Is the return worth the risk? And what Mercy is saying is think globally, but act locally. So thank you. We'll move on to the next presenter, who will be Mwenda Rarama, and he'll take us through the various asset classes that we have so that we know what is there, what is out there that we can invest in. So Mwenda Rarama, over to you.
Thank you very much, Beatrice. Decisions, decisions, decisions. Life is all about decisions. It's an issue of, you've been given information by Mercy, the macros are looking better, inflation is looking better, there are better times coming. The issue is, what do you do with that information? Where do you actually put your money? We look at the different asset classes, we look at the different attributes they have, we look at the considerations you need to make as you make those decisions. Ours is to guide you so that you make the right decisions. To start us off, risk, we always say the higher the risk, the higher the return, but also the higher the potential loss. One of the things that you must look at as you make your investment decisions is, what are your goals? What do you actually intend to do with this money? What is the aim that you want to achieve even as you make these investments? The big question is the why. I am making an investment. You need to be very clear. Why are you investing? What do you want to achieve with this particular investment that you're making? Then again, every investment comes with risk. Depending on the decision that you have made and the why you're investing and what your goal is, then that also determines the risk appetite that you can take. If it is money that is meant for retirement, then of course you don't have to take too much risk with it, because if that money disappears, there's a likelihood that you may not be able to put a meal on your table the next day. But if it is money that you're a young person, you want to start off in life, your aim is more long-term, you definitely can take on a bit more risk. So your risk appetite is largely determined by why you're investing, which is basically your goal. She did speak about diversification, and the reason you diversify is to basically limit the risk. Every single investment has a risk. Every single investment decision you make has a risk in it. But the more diversified you are, the more likely that you'll not have everything going bust at the same time. So don't put all your eggs in one basket. All comes from the same concept. Put your money in different asset classes for different reasons, because at the end of the day, as much as you're chasing a goal and you're chasing a return, diversification ensures that you do not have the same challenge hitting all your asset classes at the same time. One of the things that has become very, very important of late is who's managing your money. Fund managers have become prominent. We have gained quite a bit in terms of interest over the last couple of years, and we have built track records. Those track records will tell you the reputation of the institution that is actually managing your money. As you make these decisions and as you find your partner that works with you to manage your wealth and to walk through your investment journey, it's important to make sure that you actually have a party that you can work with, that you can trust, that has a proper track record, that actually can be able to manage the risks and the returns that you're chasing in a way that your capital is protected. The thing that becomes important as well as you move on is liquidity. At what point will you need that money, and how quickly can you access that money? Different asset classes have different levels of liquidity. If you do buy a piece of land today, in another 2 days, if you want to sell it, you probably may not be able to get a buyer as quickly. So it's important to know, and as you make the decisions and as you pick what to do with your money, depending on the why and the reasons behind the investment, that you determine the level of liquidity that is in that investment, so that you know how quickly you can access your money and when you'll need to access your money. One of the things that has been a challenge is people think investments are about large amounts. Investments are not about large amounts. It's an issue of the initiative and the discipline that comes with it. The initial investment and the contribution that you're making, the smaller it is, the earlier you can start, but it is important to make the decision and start. So different asset classes will have different initial investments, different products will have different initial investments, but it is important to start investing and make sure that it is affordable to you. So the moment you find an asset class that is affordable to you, you can actually start investing and put your money away and making the savings work for you and generate a return. That return, as well as it compounds, it grows in value, and you can therefore be able to buy the larger ticket amounts. The fees and the costs that you pay at any one time do shave away from your return. So it's important to know what is the actual cost, what are the fees I'm paying for this investment that I'm making. It's a consideration that you must put in mind, because that comes from the overall return that is being made in this investment, or rather being made by the investment that you have made. I'll move on to the various asset classes, and I'll just talk through them broadly. We have 5 of them in general terms that we actually do, and the definitions are very clear. Money market is a market for money. That it means cash and anything that is near cash, which is anything that is less than a year. So you have deposits sitting there. The government as well borrows for less than a year through treasury bills, and money market funds, which have a duration of 18 months, also fall in the same bracket. It is money that is easily accessible, money that you should be able to still earn in your return, but if you do need it, you can actually access it quickly. So from a return point of view, the returns are low, but it gives you capital preservation, because it actually is cash. It's more about preserving the capital and in your return that is higher than inflation. Mercy did speak about inflation, to ensure that inflation is not eroding your investment, that your money is actually not losing value, because if you don't invest it and it's not earning a return, it's losing value at the rate of inflation. They do have low volatility. That also ties to the risk element. How volatile are they? Cash, of course, means you're very close to cash, or you're actually holding cash. The volatility is quite low. We don't see a lot of variability in terms of how that moves. It's only largely determined by inflation. You have high liquidity. This is money that if you need, you can very easily access. Depending on the kind of asset that you've bought, of course, some do offer a bit more in terms of liquidity, others offer less liquidity, but in most cases, it's money that should be available to you from a capital point of view, or maybe a penalty on the interest, depending on what the asset you have bought is. The other thing is that you have low entry levels on this as well. Of course, being near cash, they give you a lot more in terms of access. The entry levels are lower, and they're not complex. It's actually very, very basic. You are putting in money, you're earning a certain return, and that is what happens through and through. So low complexity, low entry levels, which means it's actually assets that should be very easily accessible. As the investor, what you're looking for in this case is a safety and liquidity. You have put money somewhere that you can easily access, and your capital is also preserved. It's earning your return, but it is money that is kept safe at a low liquidity level. So when you need it, you will actually be able to access. This is where you have your emergency fund sitting. This is where you have short-term money sitting as you make decisions. Then we move on to the next asset class, which is bonds. Bonds are various. Most of what we have interacted with are government bonds that offer you a fixed income return. We also do have corporates that offer bonds as well. So what this means is that the government is coming to borrow from you for more than a year, or the company is coming to borrow from you for more than a year. They're also traded. You earn a certain interest. The return is moderate, and you have a steady income coming in, whether every 6 months, whether quarterly, but you do have a steady return because it's basically based on the fact that you have lent, so it's a loan. The volatility is low to moderate because especially for government bonds and also for corporate bonds, which are listed, they are tradable. So you'll have a bit of volatility, not in the return, but volatility in the price of the asset. The liquidity is moderate. You should be able to sell this, but depending on the size and the amounts you're talking about, you may have challenges in being able to sell them as quickly as you would want to, but they are still tradable. They are listed on the stock exchange, on the NSE, so you should be actually able to sell the same. Entry levels are moderate. The government does talk about 50,000 shillings and above. So of course, it's not as low as what you'd have in a money market fund, but you still have moderate levels of entry in this particular segment. Complexity, we rate it as medium because of the fluctuation and the movements in the price. So the returns remains stable and regular. You'll have a stable and regular income, but you have a movement in the value of the asset that you're holding, and of course that brings in a bit of complexity, and the questions of when do I come in, when do I sell, of course come into place. So as an investor, you are definitely looking for a stable and regular income. You will get that, and especially if you're going to hold these particular securities to maturity, then that takes away the complexity portion and takes away the price fluctuations, and you can earn your return, and when this asset matures, the government pays you back or the corporate pays you back your money. The next asset class is what we call equities, commonly known as shares. So you're buying a share of an institution. Most of what we will deal with are the listed companies, your KCBs, your Safaricom, your Absa, and the rest of the other institutions. They are listed. They do offer you a return in terms of dividends, but we need to remember that dividends are not guaranteed. Unlike a bond where you have lent and you have an agreed rate of return, where you know as a borrower, you are paying a certain level of interest. The government is, of course, told you this is what we'll pay. If it's at 12%, it's guaranteed. But when it comes to dividends, they are determined by the return that the institution makes. So on a particular year, if the institution makes a loss, they may not pay you a dividend. But you have a return potential that is high. Reason being, it's about the value of the institution. So as the institution grows, as they make investments, as they grow in terms of size and their potential as well, because what you are investing in is actually the potential for this institution to make money for you, then we do expect that you'll have a price gain on the same, and the potential can be anything. The same thing we say about risk and return is that, yes, you have the opportunity to make a lot of money, but institutions also do go down, and you have the potential of losing the return. But there's also, of course, and that is where the volatility comes in. The prices are can significantly move depending on the market dynamics and the economic dynamics that Mercy has taken us through. The liquidity is also high because you're talking about listed institutions. So you actually should be able to sell your shares and get out. The only thing is, because of volatility, the price may not be what you're looking for, but you definitely will get a buyer and can get your money out. In terms of entry amounts, it's quite flexible. They have now reduced the entry levels to as low as one share. So if the share is worth 20 shillings, then with 20 shillings, you should be able to buy your shares. So they do provide a lot of flexibility because it's largely determined by the price of the shares for the institution that you're actually investing in. The complexity is high because you're talking about determining the future of an institution. The determination of the future of the institution is a complex item. You do need to go through what we call valuations, looking at what the expected incomes would be. That complexity makes it difficult for individuals as well. But as you get exposed, as you definitely walk the journey with your investment manager, they should be able to guide you on some of the things you look out for to know the future of the institution and basically make the investment. What you're looking for is a growth opportunities. These are long-term in terms of nature. You're going in for the potential that you expect in terms of return. And therefore, it's important to know that you need to stay a bit longer so that you can actually benefit from the opportunities that you're seeing this institution investing in and benefit from the growth that will come out of those opportunities. The next two asset classes are not listed. They are not funds. They are not short-term. They actually are a mix of a couple of items. Alternatives basically talks about anything that is outside the traditional markets. That would be your real estate, your private equity, commodities, which would include gold, silver, and any other commodities you're looking at, including oil, your cryptocurrencies, your hedge funds, your infrastructure items, including anything that would be investing through a private partnership with the government, a private-public partnership with the government, and anything that is outside the normal equities or bonds that we actually speak to. So it's various and quite in terms of quite diverse in terms of what you'll be looking at. But the thing with the alternatives is that they also give you an opportunity to make high returns. The volatility can be very high because some of these things are actually difficult to tell what the future will look like. It's a bit difficult to, and the complexity, of course, is added onto it. So the volatility can be very high. You can have high returns, you can have lower returns. You have quite a bit in terms of movement. Liquidity, given the fact that they are in most cases not listed, liquidity remains to be low. Getting out of them may be difficult. Some, of course, may have higher liquidity levels than others, but largely we do see low liquidity levels in the alternative segment. Entry levels are definitely higher than what you'll find in the more common kind of asset classes. And that entry level means quite a number of people may be locked out of the alternative segment. Complexity, a lot of these are difficult for you to tell the future of, difficult for you to measure, difficult for you to value. So as you invest in this potential, determining that potential, of course, is quite difficult. As an investor, what would you be looking for? You'll be looking for growth, definitely, but at a higher risk. The risk that you may not be able to tell the future, the risk that you may not be able to measure the potential and the future properly and price it properly may mean you may pay a higher price than you should. You probably may end up taking more risk than you should. And therefore, yes, you'll chase the growth. There is return that comes with it, but there's, of course, quite a bit in terms of significant risk that comes into those. Finally, I'll talk about offshores. That is anything outside the Kenyan markets. International assets have grown in terms of their interest over the last couple of years locally, and that interest is driven by the returns that we're also seeing from the international markets. In terms of return, depending on what you invested in, you'd see some moderate to high returns. If you're in the fixed income side, you have moderate returns. If you're in the equity side, you'd see high returns. And in any other of the other commodities or alternative assets that you'd be investing in offshore. In terms of volatility, we have seen moderate volatility in most of these segments, and you have also seen moderate liquidity. So you will be able to get your money out, but not as quickly as you would in something that is cash or near cash. From an entry-level point of view, most of what we are seeing is moderate to high entry levels, depending on what particular assets you're actually investing in and the availability of those assets. The complexity comes in measuring the same. The moving parts are various and quite significant. That high complexity, the number of factors that you must look into as you make this investment, of course, makes it difficult for you to be able to determine the values of these particular assets. In most cases, you'll find the professional side of it has a lot more in terms of information and can be able to assist you in measuring the value and what you expect into this. What are you looking for as an investor in these particular segments? What you'll be looking for is diversification and access to global markets. That diversification that Mercy spoke to also ensures that if you have a challenge in the country and Kenya is hit significantly, you still are making money elsewhere. They may not be the same case that you're seeing globally. So I've spoken to this from a low risk to a high risk kind of level of rating. We'll move into what is common in the local markets, and how you can actually get a partner to assist you in this journey. Most of what we do see offered is through collective investment schemes, and it's particularly through unit trust funds. Unit trust funds have grown in terms of size, they have grown in terms of their ability to be able to offer solutions. So you do have partners that you're working with. These partners ensure that they can manage the risk for you, the diversification is done, and all those other things that we have spoken to. And as well, because their unit trusts are various in terms of forms, you're able to align your investment goals or your why very clearly with which particular fund you'll be looking at. The regulation by CMA as well does help, because the unit trust or the collective investment schemes are oversighted quite a bit by the Capital Markets Authority to ensure that you have another partner in addition to these particular partners that you're paying, who in this case is the government through a regulator, to ensure that they actually do keep tabs of your service providers and keep them disciplined and ensure that your money is also safe. So collective investment schemes pull money together from multiple investors, depending on the amounts that you're coming in, from as little as 100, 1,000 shillings, pull the same, they are managed professionally, you have diversification coming into it as well, and they invest in different securities to ensure that they offer you a stable, risk-adjusted return, because risk adjustment is very, very important, even as you chase return, because if you do not factor in the risk, then you may end up having losses coming into your fund. So who are the service providers in this? You have a fund manager, like ourselves. We are a fund manager, Absa Asset Management. We would be the people making the decisions. You also have a custodian bank, and in this case, the custodian is actually a bank, and they cannot be the same entity. So you'll have a different entity keeping custody of the money. So the fund manager does not keep custody of the money. What they do is make decisions, but the custodian implements the decisions. That means they're the ones who move the money. When the investment manager says sell this particular asset, the actual sale is done by the custodian, and they do move the money, move the assets accordingly, and reconcile the same and keep tabs of that. Then you have a corporate trustee. The work of the trustee is to represent the investors. Remember, this is a trust. I did say it's a unit trust, so it's actually in a trust setting. Or you have a corporate trustee and not individual trustees, like what we see in pensions and what you have seen in some of the setups in churches as well, where some churches are trusts. What we have here is a corporate trustee that is also licensed. All these three institutions are licensed by the Capital Markets Authority, who oversights them. The work of the trustee is to represent the investors and ensure that they actually do the oversight work. In other words, they're the ones who speak on behalf of the investor and ask the fund manager and look at the fund manager's decisions, ensure that they also keep the custodian accountable, and where there are challenges, then the regulator does come in to support the trustee in ensuring that the service providers do the right thing. What are the advantages and drawbacks of this? The main advantage is that it gives you accessibility and flexibility. Why? In a setup where you have a regulated, we would call this a regulated chama. It's a couple of individuals plus corporates that have come together. The funds have been pooled. They have been put in a trust kind of environment where you have a lot more happening. So it offers you more liquidity. So instead of having a scenario where you've bought into shares and you have challenges, or you have lockups in between, you have to wait for 5 years, 20 years, depending on what you've bought. You've bought a bond that is 20 years and you want to hold it to maturity, it's harder to sell. You have flexibility and accessibility. So you can very easily access these particular funds, come in with small entry levels, and you can still get out when you need to, because they offer you the liquidity, because you're a couple of you, and at any one time you have someone coming and someone else who is leaving the fund, and therefore there's always money available for you if you do need to exit. The other items are what I've spoken to, the security and the regulation part of it. Also ensure that you have a lot more in terms of reduced risk, both by the diversification of the fact that you're pooled and you're mini, the amounts are larger, the professional management does help, and the regulations as well do help a lot in ensuring that your service providers do the right things. And finally, the professionalism that is involved in managing these particular funds are a big advantage. You walk into a fund manager alone, the cost might be quite significant, but you come in a pool, in a trust kind of setting, then you have a shared cost, and therefore with whatever amounts you've come in, you still get the same professional service that you would be getting if you walked in as an individual. The thing is, the price is lower, but you're still getting definitely the same services. What are the drawbacks to this? The returns, of course, are not guaranteed across board. Most of the funds, and we're very clear, they're not guaranteed. We do offer management and these across board. There is no, the regulator is very clear. You cannot offer guarantees on any returns. And anybody who says they can guarantee a return, of course, means they're taking away the risk. If you take away any risk, then there's no return, because every return must have a risk. So there's no return that is guaranteed, but you do have professionally managed funds, which means the risk is actually being managed. So it's not about the guarantee of the return, it's about managing the risk, which ensures that you actually can benefit from the return. The other thing is, because you're coming into a pool, you, of course, as an individual investor, have less in terms of control and in terms of how the decisions are made. Most of that is done by the professionals. And like if you had a one-on-one and you could tell the investment manager, don't do this for me. But in this case, it's in a pool kind of environment. A lot of regulations come into place, a lot of restrictions come into place, and you therefore do not have the same control that you'd have. Finally, the market and liquidity risks do exist. As I said, there are no guaranteed returns. It's an issue of managing the market risk and the liquidity risks. But then again, the professionally managed management of it does take away a lot of these liquidity and market risks that you would be facing individually. So let's talk about the different types of unit trusts that we actually have in the market. The most common are what we call MMFs, or the money market funds. Money market funds are meant for short-term investments, for managing money. We did talk about the money market. The money market is a market for money. You're bringing in money, you're getting a return out of it. The actual investment that you're making is the money itself. You're not really buying an asset as such. So these funds manage money, short-term money, anything less than a year. Their duration is actually 18 months, just slightly above a year, to ensure that your money is safe. There's capital preservation. The returns are lower. They offer you high liquidity, so it's money that would sit there and can very easily be accessed. Or they invest in the usual short-term items that would be your treasury bills, your deposits, your commercial papers. And commercial papers are basically companies that are borrowing for less than a year in terms of period. There is no lock-up period in this particular segment. The investment amounts are low. What are you looking for in terms of suitability? This would be for an investor that is looking to conserve a conservative saver, or a beginner, or you have an emergency fund. That means it's money that you want to earn your return, but can easily access it when you need it. So if you're in the space where you need to be conservative, this is where you'd be putting your money. The next fund is what we call fixed income funds. So fixed income funds invest largely in bonds, both government and corporate bonds. So they are longer in terms of term, unlike the money market funds, which are 18 months and lower. So you're now going a bit longer, or looking for a higher return. So you'll get a medium return that is offered largely from bonds. You'll also have, you still maintain the high liquidity, because the beauty of being in a fund setting, as I said, you have people coming in and leaving at the same time. So if you do need your money, you should be able to access it. But you have high liquidity, but still at a higher return. And these are the benefits of being in a fund. Unlike going in a loan and you're buying a 20-year bond, you probably will struggle to sell it. And even when you sell it, it still won't be at a level that you'd be looking for. So the high liquidity taken away by going alone. But if you come into a fund, you still maintain the liquidity and still earn the returns that you're looking for. There are no lock-up periods in this, and you also have low investment, initial investment levels. In terms of suitability, this is for an investor that is looking to get a higher return, but still stable. You're looking for a stable, you're seeking a stable return that is higher than your money market kind of setting, without taking too much risk. So you'd be looking, instead of going to a bond alone, you'd be coming to a fixed income fund, still getting the benefits of a bond, but with the liquidity that the fund provides. Next, we have what we call balance funds. Balance funds sit between the fixed income fund and the equity fund. As we did talk about the different asset classes, I did say we have bonds and we have shares. So what a balance fund does, it buys both bonds and shares. So it gives you exposure, it gives you a stable return, but also gives you the aggressive returns that would come from shares. So it gives you a balance of the two. So if you are buying into this, you're looking at a higher return, definitely, and they do offer high returns that are driven by the shares that are in these particular funds, or the equities that are in these particular funds. They still offer you the liquidity, so moderate liquidity in this case, because in some cases, remember these are long-term assets, there might be a bit of a delay in being able to liquidate them and provide you the liquidity that you're looking for, but they do provide liquidity across board. There are no lock-up periods in this, and the initial investments are also low. So if you're a balanced risk taker, you don't want to take too much risk, but you still want to benefit from good returns, this is a fund that you'll be looking to come into. So for anyone who's a medium-term investor looking for a balanced risk, balanced return, then the balanced funds would be what you'd be investing in. Then we have the equity funds. The equity funds primarily invest in shares. This is about capital growth. You do want share prices that go up. The beauty is that you have a partner that you're working with you. You're not the one deciding, do I buy Safaricom today? Do I sell it? There's someone making those decisions for you, who is basically the fund manager. The returns are high. The liquidity is moderate, just like in a balanced fund kind of setting, because the beauty is because you're pooled, then you are able to provide a bit more liquidity than you would if you were in shares alone. There are no lock-up periods. The initial investments are also low. So for any aggressive investor who is searching for capital gains, this is where you'd want to sit, because it's primarily investing in shares, primarily investing in companies, primarily chasing capital gains, and of course the dividends that come with it. Then finally, on the higher side in terms of risk, we have the special funds. Special funds are tailor-made depending on the strategy of the funds, and they're very specific in terms of themes. Special funds have not been very popular, but they have started gaining popularity as well in the recent past. The returns are high. The liquidity on this case is low. And you do have lock-up periods. Of course, that lock-up period means lower liquidity as well. And the lock-up periods do differ depending on the different providers. You have high investment amounts as well, because the kind of assets and the kind of strategies that you do need higher capital investments, especially if you're doing anything offshore and anything else. So special funds, of course, as we said, do provide largely investments in alternatives and offshore. And that alternatives and offshore segment that is quite complex does mean as well that the amounts required are significantly higher. So it's suitable for someone who's aggressive in terms of return. You're an aggressive investor, but you're also interested in very niche focused kind of investments, or very strategy driven or specific strategy driven kind of investments. And that's why most special funds will largely cater for two asset classes, that would be alternatives and offshore, whereas the rest of the funds that you have spoken to do cater to the other funds, the other asset classes that we had spoken to. Finally, what are we saying, or what are we telling you? It's important to build a portfolio that is resilient, and portfolios that are resilient are built on diversification and very, very mindful risk management. Risk management is at the top of it. I always joke and say that investment managers are more of risk managers than investment managers. It's about being able to measure the risk, because if you don't measure the risk right, then you risk the return that you're chasing at the end of the day. So a resilient investment strategy would balance the opportunities with the risks that come with it, ensuring that your portfolio can withstand the shocks, because every so often we'll have shocks into the market. If you don't survive the shocks, if your capital is wiped out, then you of course will not benefit from the growth that will come post the shocks. You need to make sure that your asset choices are very clear in terms of what you're picking, and that is driven by your risk profile. What is the level of risk appetite that you have? What are your investment goals? Those determine your risk profile. And as an investor, as you pursue your stable and sustainable returns, it's important to make sure that you measure your risk. As we always say, the higher the risk, the higher the return, but as well, the higher the potential loss. I'll hand over to Beatrice. Thank you very much.
Wow, wow, wow. I don't know what to say. If this was a cake, I bet it would be the centerpiece. Because even from the reactions we are getting from the online chat, the questions and comments are coming in fast and furious. So Mwenda, I hope you have some energy reserved to answer the questions. There are quite a number. So what I kept hearing was risk, return, risk, return. So I guess that's the name of the game here, and it aligns properly with our punching line, which is the return worth the risk? So Mwenda, on to our first question from the chat. How do I get to know the underlying assets of an investment?
Thank you. So the beauty with the regulated entities and the regulated environment is that we have an obligation to share with you what we call a fact sheet. What that document does, and it's shared on a monthly basis, is it actually articulates what are the assets that you have invested in, what are the asset classes you have invested in, what exactly have we bought, where is the return coming from? Because if you don't know where the return is coming from, then that's where the challenge comes in, because you may not have the likelihood of that return being maintained. If you're not clear where it's coming from, then you have a challenge, of course, in determining. As we said, as an investor, ours is to walk with you the journey and help you make the decisions. Those decisions are easier to make if you look at the fact sheets that are available across the market. You'll be able to see the underlying assets that these investments that are delivering the return that you're looking for, Beatrice.
Wow, thank you for that. We have another question from Peter Kangede, and he's asking, regarding the offshore investments, can we have visibility of the specific funds, stroke equities you're recommending? Could you just maybe mention example of the equity funds?
What we have are structured funds, and I know Fiona will be speaking to this. We do have structured notes that we actually offer for offshore investments. Most of those discussions are very bespoke. It would be good to have a setting. As I said, the investment amounts are also higher. We talk about $250,000 in terms of investments, but we can have a sit down for those who are interested, have a discussion, guide you from a professional investment point of view, and help you make the decision even as you make the investment, because they are not in a fund setting. They are actually more in a structured setting. So we would be discussing with you on an one-on-one and guiding you on what we think and what our thoughts are and where you should actually put your money. Thank you.
Thank you very much, Mwenda. On to our next question. Can you give examples of undervalued shares in the market?
There are a couple of things that we look at in determining the value of a share. Most of what we have seen in the market is over the last 2 years, you have seen significant growth. We are still seeing lower valuations than what we have seen in the past. Whether you look at the book values of banks, if you look at the potential in terms of the growth that you're expecting. As Mercy did put it, we do expect money supply will pick up. We do expect consumption will pick up in the next couple of years from an economic point of view. So quite a number of the stocks that we're actually seeing would still have potential for gain. As to the size and the amount in terms of potential to gain, that of course takes a bit more in terms of analysis, but generally we do expect that we'll see growth even this year and even as we head into the next year. Thank you.
All right, on to our next question from Joanne Kibet, and she asks, all factors considered, should I therefore go for an active or a passive investment?
I would say the best bet you have is to go this with an investment partner. That would be a fund manager who makes the decisions for you. Active management, or rather active trading, has costs that come with it. Every single transaction has a cost tied to it. That cost at times can be very prohibitive in terms of how you're investing. As well, we have seen passive investments offering a better return over the long term. So depending on the investment goal you have, the investment horizon you have, then definitely you will be able to make the decision. But if you're going into active investing, I would recommend you go in with a partner that actually does the active monitoring of the portfolios for you, does the active management of the same for you, or go into a fund, because those are actively managed. Where else, if you're doing passive, then make your investment, give it the time horizon that you're looking at, and come back and see how much you've made out of it. But for active investments, given the complexity that comes with it and the costs that come with it, I would recommend going in through a fund. Thank you.
All right, we also have a comment from Eric, and he says, equities are more appropriately classed as high risk because of their high volatility. Also, not all stocks are liquid. I think with that, maybe I'll just repeat what Mwenda said. The higher the risk, the higher the returns. and maybe the higher the potential loss as well. So as you invest, please have that in mind. In the interest of time, I will invite our third presenter, who is Fiona Lucalo, to give us, now that we have the global picture, we have the asset classes or what we can invest in, then Fiona will take us through the solutions that we actually offer at Absa Asset Management Limited. And as we do that, now that you know the different kind of investors that are there, please respond to the poll that we are going to post on our chat, and we'll give a summary of the same at the end of the webinar. Thank you. Over.
Thank you, Beatrice. So, heroes, allow me to take you through the Absa Asset Management Limited product offering. We have various investment solutions for you, our clients, ranging from pension solutions to investment solutions, both short-term and long-term, depending on your investment goal. So drilling down to this, for the pension solutions, ideally for discretionary mandates, we look, it's mostly suitable for institutional investors who are looking for a professional fund manager to manage their pension fund and give them a relatively good return whilst managing the risks. We also have collective investment schemes, and ideally these are unit trust funds, which we have been extensively been taken through by my colleague Mwenda. We also offer wealth management services, and this ideally compose mainly of the treasury bonds and the euro bonds. These are pretty stable investments that give our investors a relatively stable income for medium to pretty much long term. And we also have offshore structured notes. Ideally, these are for investors who are looking to play in the global market and are looking to diversify in terms of currencies. Last but not least, we offer umbrella funds. And for umbrella funds, we are saying this is mostly suitable for employees who kind of come together and are keen on setting up a pension scheme for their staff members in accordance to the Retirement Benefits Act. So we have a wide variety of services that we're able to offer for both our institutional and individual clients, so everyone can be able to or should be able to find a solution that fits them. Shifting gears, it will be important to look at how we performed the last 12 months in terms of our return. We were able to experience strong returns, which were largely driven by robust stock market performance and a declining interest rate environment. So looking at our unit trust funds, we were able to deliver 54.8% for the equity fund over a period of 12 months. This was followed by 24.1% and 21% recorded by the balanced and the fixed income fund respectively. Looking at this as well, we see that the money market fund continued to record stable returns, recording performances of 11% for our Absa Shilling Money Market Fund and 4.5% for our Absa Dollar Money Market Fund. Moving on, we wanted to really focus on our Absa Fixed Income Fund. And reason being, if you look at the current statistics, I would say over 60% of our investors who invest in the unit trust funds actually invest in the money market fund. So for investors who are really looking to diversify and are looking to invest in an alternative investment other than a money market fund, a fixed income fund can actually be a very good option for you. So it's therefore very important for us to take a look at the fixed income fund in depth, understand how this fund operates, what are the pros and the cons, and then just evaluate and see, does this actually align to our various investment goals that we have. So drilling down on this, just to understand on the fixed income fund, the underlying assets are usually the government bonds, treasury bills, and of course high quality corporate debt. The beauty with this fund is that it's able to offer very stable returns and regular income over a moderate risk. So you'll find that within a moderate time, in terms of 5, 6, 7 years, you're able to earn a stable return whilst managing your risk. The fund earns returns through interest payments and of course bond price appreciation. So it's important for us to understand what are the pros of investing with a fixed income fund. So first of all, we're able to earn stable returns compared to investments such as equity or special funds, which are very volatile. Another advantage of this is that of the fixed income fund is that it's able to offer our investors better returns compared to the money market funds and over a medium term kind of setting. Our investors are actually also able to obtain regular income through the interest payments, which ideally is done on a semi-annual basis. And last but not least, for investors who choose to invest in this fund, they're able to diversify the exposure. Since this fund, of course, invests in multiple fixed income securities, and therefore, as a client, you're able to diversify your risk when it comes to the investments that you've actually invested in. Looking at the other side of the coin, there are always every pro has a con. So one of the disadvantages or risks, let me say, of investing in the fixed income fund is that number one, the interest rate risk, whereby should the interest rates rise, the value of the bond ideally will fall. And then as well, returns may lag inflation in hyperinflationary periods. So as I had earlier alluded to, for our investors who are looking to kind of diversify their investments, maybe you already have a money market fund and you're looking for another solution that can still give you regular income, but at a moderate risk. This is a very good option or a very good alternative that you can actually try and see if the same can be able to work for you. So moving on, and as I finalize on my short presentation, is just to encourage you, for all our heroes who are yet to invest, start now, start today. Would love to serve you and would love you to start the journey with us, and would love to be able to walk with you through this investment journey. So feel free to start the journey with us. Visit our website. And we have our application form on our website. You can be able to download our application form, fill in, and we'll get you started on the investment process. Otherwise, you can also feel free to visit all our branches countrywide. We have our able colleagues there. They're willing to help you and to serve you and to help you get started on this investment journey. So as I finalize, I think for me, my parting shot would be success is not just about making money, it's about making a difference, and smart investing helps you to do both. And here at Absa Asset Management Limited, I think we are very ready to help you start this investment journey, to help you, I mean, at the end of the day, to help you be able to reach your financial goals. So start today and start now. Thank you so much, and I think I'll hand this over back to Beatrice.
Wow, thank you so much, Fiona, for that insightful, detailed, and a good presentation. Now that you're equipped with information from global to local economies, to asset classes, and the products that we have being offered for you as a solution for your investment, I guess the only thing I can say is the best time to invest is yesterday. But the next best time to invest is today. We have shared the application forms online, but we also need to know from you, now that you are armed with all this information about risk and returns and what it takes or what it means to be an aggressive or a low-risk taker, please respond to the poll on the chat so that we can get to know what kind of an investor you are. I think we'll continue with the question and answer session, since I can see the questions are still streaming in. And maybe I'll start the first question, which I will assign. Alice Mungai is asking, what funds like what funds like AML is doing to what is AML doing to compete with the special funds that are gaining higher market shares, especially with the young investors? I think this one, Mwenda should be able to take it.
Thank you, Beatrice. So what we have in offering to compete with the special funds, yes, there are new popular fund. As Absa Asset, we are looking into it and seeing what we can actually be able to do about that. So we are going through the scoping of the same, so we can offer you a solution that works for you. But in the Absa space, we do have solutions, the beauty of being a multinational. Most of these offshore kind of investments that are being offered in special funds are available through our structured notes across the Absa network, and we have them on offer. We also do have listed ETFs that you can access, including the gold and the recently one that, the Citrix one that was actually listed. So you have them, we have the same items available for you through the Absa kind of network. So for the smaller kind of investments, you would be looking into the listed, the two listed exchange-traded funds on our Nairobi Securities Exchange. For the larger ticket items, then the structured notes do offer a solution. Let's reach out to us. We'll have a sit down. We'll provide you a wealth manager. We'll have a discussion with you, guide you on the best structured notes available, because we have a myriad of options in terms of structured notes that are available across the Absa fraternity. But we do have people who can guide you and have those discussions with you. And they give you the same access the special funds would offer you, but with a more structured kind of setting, a more understandable kind of setting, and of course, better managed risk that comes with some of these investments. Thank you. Back to you, Beatrice.
Thank you, Mwenda, for that. And the next question I'll request Fiona to support. Kindly let us know where or which branch of Absa, where can we find fund managers to consult on various investment decisions? This is a question from Michael.
Thank you, Beatrice. As I had earlier alluded, our heroes can visit any Absa branch. I think our colleagues are well versed with our investment solutions. They can be able to give guidance and further information and on how to sign up on our investment products, and even just further information on the same. They can also reach out to us here at the head office. I think we'll be able to flash our phone numbers at the end of this, so that you can just also pick our contacts. Yes, thank you. Pick our contact details. Feel free to reach out to us also here at the head office, and we'll also be able to guide you through and give you, any advice that you may need, answer any questions that you may have, and guide you through the onboarding and eventual investment process. Thank you, Beatrice.
Thank you so much for that. Maybe the next question I'll pose for Mercy to support in answering. A fact sheet on the investment may not be self-explanatory, forcing one to seek answers. It's advisable to have regular sessions like this one. I guess it's just a comment, Mercy. Please clarify on the risks and liquidity on investments. How do I, for example, get to know the risks? Maybe you can answer the second question, the same person. This is from Samuel Mogere.
Thank you for that question, Beatrice. So as Mwenda has expounded quite deeply, the risks vary according to the asset classes that are invested in a specific fund. So as Mwenda has mentioned, the more liquid, more short-term funds do tend to have lower risks. So these are your money market funds or your fixed income funds. And then as you go up in complexity, they do tend to carry with them a higher element of risk. So this goes for your balanced funds, your equity funds, and your special funds. So even as you're through the fact sheets, and as you have rightly mentioned, sometimes it can be a bit difficult to understand the specifics of that fund. There usually tends to be a general description of the asset classes that specific fund invests in. So it's good to have a look at that description and get to understand exactly what that fund is investing in, and has been mentioned earlier and quite adequately described. Each fund does have the specific asset classes that it invests in and the specific risk that comes with that as well. Thank you.
Thank you so much, Mercy, for that answer. We have our next question, which is more of a comment first, from Jashon Owino. And he says, I appreciate the training. My question is, why are your money market rates lower than that of your peers? Even the new entrants offer better rates than Absa. To me, it should be the reverse, considering your wealth of experience. That's a compliment, and thank you for that. The stability of Absa Bank, etc. Jashon Owino. Mwenda, maybe you can assist to answer that.
Thank you, Beatrice. So one of the things we spoke about is risk-adjusted returns. The level of risk that you're taking will determine the kind of return you're able to deliver. Having been in the market for a couple of years, Absa has had a track record over the continent and across in delivering returns that are actually risk adjusted. We have seen shocks come into markets, and at the end of the day, you ask yourself, will you be able to survive the shock? The length and the track record of an institution tells you that they have actually been able to weather the storm, survive the shocks. Those shocks are survived because you're able to determine the risk, measure it properly, and ensure that you actually offer a consistent, proper risk-adjusted return. We have seen a couple of these challenges in the market. We definitely are working hard to deliver the return as well, but we don't want to take risk that will actually wipe out your capital. Capital preservation in most of these funds is very important, and that's the reason why, especially for the money market funds that are short-term, the priority, as we said, is a conservative investor who wants to make sure their money is safe. The safety of that money means that we actually must prioritize the safety of the funds and ensuring that even during the periods of shock, you're able to survive. We have, as Absa, have that experience that is basically part of our track record and part of what we do and do very well to ensure that even during the difficult times, we are still able to give you a proper return and ensure that your capital is safe through and through. Thank you.
Thank you, Mwenda, for that. What I hear you saying is safety, safety, safety. And this is what we all want to hear about our hard-earned money and where we've invested in. So our next question, and I'll give it to Mercy. What are the underlying assets in your structured notes?
Thank you, Beatrice. So structured notes, by their nature, are quite flexible. Depending on your provider, they can determine what underlying assets they would like to invest in for the structured note. So currently, we do provide structured notes which either have fixed income securities as the underlying assets. So these would be your bonds, your bills, your corporate bonds, etc. We also have structured notes that have equities as the underlying assets. This would either be through mutual funds or exchange-traded funds, and depending on the specific market that an investor would be interested in, whether this is the US or Europe or emerging markets or even a more balanced approach, we do have several structured notes that would cater to that. So please feel free to reach out to us on the contact details that have been provided, and we should be able to give you advice on that. I think, Mwenda, you could also speak to that.
Thank you, Mercy. On structured notes, and the reason why we do advocate and sell structured notes is because they give you two main advantages. One, they give you the potential for the return, but they also do cap your losses. You put into a structure things that are different, and that's why we're not talking about something that is just listed. You want to make sure that you have a kind of a cap in terms of the losses that you can actually make. So the structured notes that we offer you a low, or rather reduce your risk significantly because they tie in different assets, including the equities, whether offshore equities, mostly the US. We do have them in dollars, we have them in pounds as well, to ensure that we actually give you access, yes, to the equity side of it, and to the potential of the great returns that we are seeing even in the global markets. But we don't want you to wipe out your capital. So we tie in two different securities to ensure that actually, even as you benefit from the returns, your capital is also preserved. So you have a limit in terms of the losses you can make, but you have no limit in terms of the returns that you can make. That is very important to ensure that, as I said, at Absa, we are very keen to manage the risk. And the way you manage the risk is ensuring that the capital is preserved. And that's why we are keener to sell structured notes, and unlike most of what we are seeing in the market, to ensure that we actually do have a preservation of your capital, even as we give you exposure to be able to make the good returns that we're seeing out there. Thank you.
Thank you, Mwenda, for that concise answer. Now, the next question goes out to Fiona. What is the duration of investment under the fixed income fund? The question comes from Isaac Njuguna. Please proceed.
So thank you, Beatrice. So for the fixed income fund, we see it's pretty much a medium-term investment solution. So for that, I would put it for around 3 to around 5 years or so. as a duration. However, remember for the fixed income fund, it's still part of the unit trust funds, and therefore we say the liquidity is high, therefore a client can be able to exit at any point in time. However, we recommend around 2 to 5 years or so for you to really be able to generate a good return on the same. Okay.
All right, thank you for that response. So we have another question from Nasimiu, and she says, there have been lots of posts on social media on avoidance of investment in money market this quarter. Any info as financial advisors you would share as a guidance to investors what do we need to look out for in this season regarding money market? So Mwenda will support us to answer that question.
Thank you, Beatrice. In the wake of COVID in 2020, we saw the popularity of money markets grow. Why? Because as risk grew, inflation as well grew, and as that happened, interest rates went up. So of course, money market funds, as I said, are short-term, that is cash and near cash, which means at all times, they do tend to track interest rates quite closely. So during the high interest rate environment, money market funds offered a very good return, as high as the double digits that we saw in terms of interest rates, because they do track it. And that's a bit with short term. They adjust very quickly to interest rates, and therefore as interest rates went up, they did adjust accordingly. As rates have started coming down as well, we have seen them adjusting as well. So we have seen rates come lower, and therefore money market funds have also adjusted lower. During low risk kind of environments and low interest rate kind of environments, low inflation kind of environments, and we expect growth, then you'd want to put your money in something more long term, because you're able to measure the value a bit more, which is why increasingly what we are seeing is investors being requested to move away from money market funds and look long term, take a bit more in terms of risk, because they now are able to measure the risk a lot better and deliver a lot more return. Our recommendation would be moving to fixed income funds. It's a longer duration, but still offers you the stability in terms of return. For the others as well, the returns are there. We have seen the 54% from our equity fund in the past 1 year. We do have that kind of return still being delivered, but as well, you need to be cognizant of the risks that you're taking. So depending on the risk appetite, depending on your investment goals, then we do have the longer term funds that would start off with the fixed income fund, to the balanced fund, to the equity fund, and then of course the structured notes if you're looking at alternatives and offshores as well. So we do have all the offerings available depending on your appetite as well, but let's have a discussion and guide you. But for anybody who's in a money market fund, the immediate fund that you'll be looking at would of course be the fixed income fund in terms of diversification to offer you better returns and to be able to take advantage of the lower risk levels that we are seeing today. Thank you.
Thank you so much, Mwenda, for the response. We have a comment from Laura Madanga online, and she says, mine is not a question, but a comment. I would tell anyone who is a novice to consider utilizing the services of a financial manager. My mother, who stays in the village, got a really great manager, Absa branch, who helped her manage her money well, and as a result, she has been getting monthly return on investments. Wow. Thank you so much, Laura, for that. What I can say is tell a friend to tell a friend. Don't keep the secret to yourself. As we go to the next question, there are many comments coming in, but we also would like to know, what kind of an investor are you? Now that you know there are low-risk investments, there are moderate risk investments, and very high-risk investments. Where would you place yourself on the poll? Kindly reach out to our chat and help us know or understand you better by answering the questions on the chat. I'll go to the next comment or question. There are so many comments coming in about very insightful, and we should do this more often. Let me just go to the next question. Please advise on the investment that can help us earn 30% return. This is from Charity Nganda. Mwenda, I think you can take that.
Thank you, Beatrice. We did have a table that showed you the various returns that we have been delivering for the last 1 year. At the top of it is the equity fund. Returns are largely tied to the risk that you're taking. and during low risk environments like the ones you're seeing, then of course you do tend to see higher returns on some of these, and mostly recoveries. So you have seen a recovery in the equities market over the last 2 years. So if you're looking for returns above the 30%, then definitely we'll be looking at the more risky assets. The equity fund in particular has been able to deliver a 54% return in the last 1 year. The balance fund, which has a mix of both the fixed income and the equities portion, also should be able to offer you a less in terms of risk exposure, because it does have the fixed income portion and the stability of the fixed income side, but still offers you the returns that you would see in the equities fund. So if you're looking for anything above 30%, then those would be the two funds that you're looking at. The fixed income side of it, of course, offers a lot less. If you're looking for much more sophisticated, higher returns, then that's when the structured notes come in. So depending on the ticket sizes and what you're looking at, we can have a sit down and be able to guide you on which structured notes fit you best, so that you make a very informed decision and ensure that as you chase the return as well, your risk is capped and your losses are also capped. Thank you.
Thank you, Mwenda, for that precise feedback and response to the question. We have a question from Peter Kangede, and he asks, what is the minimum investment for USD money market? Fiona, you can take that away.
Yes, thank you, Beatrice. So for the Absa Dollar Money Market Fund, the minimum is $100 to begin with.
Maybe you can also speak about the shillings so that everybody knows they can be investors at their level.
So for the shilling and the other Kenya shilling unit trust funds, Absa unit trust funds, minimum is 1,000 Kenya shillings. For the dollar is $100. So it's democratic. We can all begin investing, I think, for sure. Patrice.
All right, thank you for that. Comments and questions and queries are coming in fast and furious. We are still getting more comments regarding very insightful webinar. I'm quite informed, and the presenters are also very experienced, you can tell. More insightful, thank you, glad to have been invited. Are the returns indicated in your slide net of fees or taxes? This is a question from Eric, and I would like Mwenda to speak to it.
All the returns that we publish in the newspapers and the returns that we indicate are net of fees, but gross of taxes. So if you're a taxable individual, your withholding tax in the case of the interest earning kind of funds will of course be deducted. But if you're not taxable, that is the return you earn. So any return that you see us publishing in the newspapers and any returns that you see us showing you are always net of all our fees. Those are the net returns that you get, except for the tax portion. Thank you.
Thank you so much, Mwenda. We have a question here about the fact sheet, and this is from Samuel Mogere. I have perused through the MMF fact sheet. What has been your average performance since inception in 2022? What was the average performance in the third quarter of 2025? I think Mercy should be able to support us with this.
Thank you, Beatrice. Apologies, I may not have the exact figures off the top of my head, but I believe performance for the money market fund should average between 9 and 10% since inception. As has been mentioned, money market funds tend to have lower returns because, again, you are taking a lower degree of risk. So with the exception of high interest rate periods like what we saw last year, you do tend to just have an average return of between 9 to 10%. And as we have seen, interest rates have declined quite sharply over the last 12 or so months. So over the last 3 months, I would also expect that the interest or the return on the money market fund has averaged around that level. Thank you.
All right, thank you, Mercy, for that. So we have a comment from Flora Birengo, which I would like to share. Thank you for the invitation to this great informative session. I'm a bit of a new learner and learning current economic terminologies, but I'm a willing learner and quite interested to learn more to get into the investment world. Thank you for creating such a forum to educate and empower. We appreciate the comment, Flora. And keep your questions coming. We are still here. And please respond to the poll. We need to know the kind of investors that we have at Absa Asset Management or the potential investors that we are about to get. So please keep the comments coming. I think I'll keep repeating my statement. The best time to start investing was yesterday, and the next best time to start investing is today. So if you have not invested, please take action. We have branches all over the country. We have more than 80 branches which you can reach out to, and that's one of the biggest footprints in terms of outlets. So feel free to walk into any of our branches. We have trained people at the branches. They'll be able to take you through the process of application, and that should come through to us. So in the interest of time, I think we are coming to the end of the session. But before we end, we'd like you to respond and give us feedback about the session. We know you've given some feedback, but it would be important for you to even give more feedback. This will advise what we need to improve on our webinars now and in the future, and any topics that you'd want us to consider for such webinars. So please scan the QR code. It will take you to a link with about 7 questions. Support us by answering the questions. We really appreciate that you made it today. I would like to start by thanking you for participating, being present, and we don't take it for granted. And also maybe to thank our presenters, our 3 presenters, very experienced. They've shared their experience, they've shared their time. We don't take it for granted that they were able to be present and be able to respond to all the questions that they have responded to. What has not been responded to at the moment, we will for sure respond to the questions after the session. So don't feel like we have let you down. At the end of the webinar, we'll also, because we've been recording, we'll also be able to share the recording as we send you the thank you note. So whoever joined late or after we had begun, don't feel left out. We will be able to share the recording for you to listen and maybe share with your friends. So this brings us to the end of today's session. A huge thank you to all of you who made it. And thank you all for joining us. We'd love to hear your feedback, so feel free to give us any feedback using the QR code, which will take you to a link. Until next time, stay informed again and invest wisely. Thank you so much, and until next time, have a great day.